Hello everyone and welcome back to my channel. Today we are diving deep into the latest quarterly and annual results from Tata Consultancy Services, India's largest IT services company, better known as TCS. We will focus on the Q4 and full fiscal year 2025 performance, analyze the numbers and explore what these results mean for FY26. Let's get started. Let's begin with TCS fourth quarter performance for fiscal year 2025. The company reported revenue of Rs 65,287 crore, representing a 2.5% constant currency growth year on year. Looking at profitability, TCS posted an EBIT of Rs 17,207 crore with an EBIT margin of 26.69%. The company achieved a profit after tax of Rs 12,292 crores for the quarter. When we compare with the previous quarter, we see some interesting trends. Q4 revenue increased from Q3's 63,974 crore, showing positive momentum. However, margins declined to 24.2% in Q4 from 26.42% in Q3, which is a concern worth monitoring. Here are some key metrics of Q4. Revenue Rs 65,287 crore, EBIT Rs 17,207 crore, EBIT margin 26.69%, PAT at 12,292 crores, EPS at Rs 33.99 and order book of $12.2 billion. Full year performance. For the full fiscal year 2025, TCS reported solid numbers. Annual revenue of Rs 2,35,340 crores. Overall margins of 24.3%. PAT of 48,777 crore and an EPS of 134.14 rupees. Total dividend of rupees 126 per share was given by the company. The company deferred wage hikes during FY25. The deferred wage hikes helped to maintain profitability of the company in this challenging market condition. This strategy supported the bottom line, but it isn't sustainable for long-term talent retention. It's worth noting that the total contract value signed in FY25 was $39.4 billion, which represents a decline, a fall from the FY24's order book of $42.7 billion. While the order book remains substantial, this reduction signals some challenges in closing new deals. Market challenges and headwinds. First, there is a noticeable delay in discretionary spending decisions in US market, largely attributed to the ongoing tariff war. The uncertainty has created a cautious environment among clients. Second, growth has slowed considerably and margins are under pressure at 24.3% for FY25, way below the guidance given by the company in quarter 3, which was of around 26 to 28%. With the backdrop of global economic uncertainty, these factors warrant close monitoring. The company specifically mentioned that the Q4 was affected by soft discretionary spending, continuing a trend we saw in previous quarters. However, management remains optimistic for FY26. And why? Let's see. Positive indicators. Despite these challenges, there are several positive signals from TCS Q4 FY25 results. Number 1, Q4 order book stands at $12.2 billion, which is the second highest quarterly order book in the company's history. Notably, this doesn't include any mega deal or renewals, suggesting a healthy pipeline of medium-sized contracts. Management is optimistic about medium to long-term growth prospects, particularly in AI in business and generative AI implementations. They view the current uncertainty as short-lived. The company firmly believes that FY26 will be better than FY25 based on the total contract value signed in recent quarters. This confidence suggests potential for improved performance in coming fiscal year. Analysis and outlook. So what should investors make of this Q4 FY25 results? TCS clearly faces near-term challenges with slowing growth and margin pressure. FY25 margin of 24.3% falls way below the guidance range of 26 to 28%, raising questions about ability of TCS to achieve the target in coming quarters. However, the company's revenue growth of 7.9% quarter on quarter is encouraging, combined with strong order book of $12.2 billion in Q4 alone. These are reasons for cautious optimism. It will be prudent to reassess the company after Q1 FY26 results are released. The first two quarters of FY26 will provide a clearer picture of whether management's optimism is justified or if the challenges are more structural in nature. For long-term investors, TCS position in India's IT industry is very prominent and very promising. The dividend payouts are attractive, but in near term, be cautious. Conclusion: to summarize, TCS's Q4 and full year results show a company navigating through challenging market conditions with mixed success. While Q4 showed revenue growth, margins faced pressure throughout FY25. The company maintains a strong order book and positive long-term outlook, particularly in AI-related services. Investors should watch for improved discretionary spending, especially in the US market, and monitor whether margins begin to return to the guided range of 26 to 28% in the upcoming quarters. That's all for today. If you found this video helpful, please smash the like button and subscribe for more stock market insights. Drop your thoughts in the comment box below and let us know which company you would like us to analyze next. Until next time, happy investing.